class, I'm going to use the term security when referring to any tradable financial instrument. This includes stocks, bonds, commodities, futures, indices, mutual funds, options, CFDs, and cryptocurrencies. So while I may specify a specific investment product, like I may say shares or I may say Bitcoin, these investment concepts that we're talking about tonight will work with any publicly traded financial instrument in which an open market exists. Now, similarly, I'm going to intermix the terms investing and trading. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. In either case, the basic concepts and techniques presented in this class are equally adept. It just gets very, very boring hearing me say investing, investing, investing. So I mix up investing and trading. I'll mix up cryptocurrency and Bitcoin and Forex, and I may say the euro. It's just because otherwise it just gets very boring. But I'm referring to the entire market. So let's start learning how to trade from economic news and using the economics calendar. Now, trading the news can be very profitable if you can correctly guess which way the market is going to move. You can often pick big moves of 30 or 40 pips very quickly on big news releases. But knowing which way it's going to move is very much a gamble. So most traders do not trade the news as it's just too risky. And you often get stopped out as price moves one way and then the other, because whether it's news that Donald Trump is making, news is coming out of Saudi Arabia, or an economic event such as the jobs report, it can spark volatility in the markets. And it's very hard to be able to figure out where to put your stop loss when the markets become very volatile. So it's very hard to employ proper risk management when in these type of markets. So most traders have experienced this whipsaw effect when price goes down and then it goes up and then it goes down very quickly and then back up again. So it seems no matter which way you trade, you always seem to get stopped out. Well, that can be very, very true. But there are ways to trade news or economic events. But let's forget about necessarily trading them. Okay? You have to understand what these events are. You know, we can't predict what Donald Trump's going to say. We don't know when he's going to tweet something crazy. We can't predict when Parliament is going to make a final vote on Brexit or what's going to happen. So we can't predict that. But when it comes to economic events, we know precisely when they're due to come out. We know what time, what we should expect. We know what it was the last time, and we know what the forecast is for this market. Now, regardless whether we're going to trade that event or we're trading something completely unrelated, by not knowing what's on the calendar and how to use the calendar, what these events affect, you might have a trade in, say you traded B&Q stock or Kingfisher stock that owns B&Q, okay? What if for whatever reason, and the housing data comes out in the UK and it's really bad. But you haven't looked at the economics calendar because there's no press releases scheduled for B&Q and Kingfisher. So you don't pay any attention. What happens is housing market comes out really bad. Housing market's bad. B&Q sells what? Home renovation products. Housing market goes down, the sale of these, because when the housing market goes down, people tend not to fix up their houses. They don't tend to pay hire contractors, so sales fall in the B&Q stores. But because you didn't pay attention to the economics counter and the economics event, you made a bad trade. So it has a very broad effect. A bad jobs report, or what we call claim account in the UK, can see the FTSE fall. So if you have been trading the indice, guess what? You were trading the UK 100, it plummeted, but you didn't pay any attention to the jobs report. Now, when an economic release comes out, markets can react violently as traders enter and exit positions based on this news. Some news releases are far more important than others, like the non-farm payroll report for the US. That's coming out this Friday. It comes out the first Friday of each month. So what happens? You know already way ahead of time that there's an event. There's an event that's going to affect the markets. Well, when you know something in advance, you can prepare for it. Also, there's central bank announcements that typically move the needle more than most. A big speech by Mario Draghi can send the euro plummeting and he can chat that euro way back up. Now, there's good reason for central bank announcements like rate hikes to directly affect the money supply, which has a major bearing on the economy. While CPI, which is inflation figures, and unemployment numbers can influence central bank policy. Well, if they raise interest rates, BOE comes out very bullish that they're going to raise interest rates. That has a negative effect on stocks. Why? Because most companies have debt. Debt is based on interest rates. Debt gets higher, or interest rates get higher, the company has to pay more money in interest rates. So their debt is larger, or their costs are larger. But these days, sophisticated algorithms are able to process news releases in a blink of an eye and move the markets accordingly. Financial markets, therefore, adjust quickly to the new information. Even so, the biggest news releases create opportunities in the market because they can cause long-lasting price movements or momentary distortions of the efficiency of the markets. So I've got a little presentation I'm going to share with you on understanding what fundamental analysis is, because all of this falls under the auspices of fundamental analysis. Whether it's a press release, whether it's an earnings report, whether it's a central bank action, whether it's a speech, or whether it's something Donald Trump does, it all falls under this field that we call technical analysis.
Fundamental analysis involves studying the economics of a country and determining the effect this has on the value of its currency. There are economic indicators that traders can observe in order to determine the strength of an economy. They are released as reports at certain times, and they can be released weekly, monthly, or quarterly, depending on the report. If an economy is determined to be strong, foreign investors will seek investment opportunities in that country, because a strong economy is more likely to present opportunities, such as returns on real estate or the stock market. In order to invest capital into a country, an investor will first need to convert their capital into that country's currency. If it is therefore perceived that the economy will produce great returns for investment, then that country's currency will be more in demand, and hence the currency value will appreciate. So, if US investors wish to invest in the UK because the UK is showing a strong indication of a growing economy, the demand for the pound will increase, and so the value increases. If the economy is seen to be weak, then investors are likely to seek investment opportunities elsewhere in a stronger economy, withdraw capital, and convert it to the stronger economy's currency. The currency of the weak economy will depreciate in value because of the lower demand for it. So when economic reports are released, investors and traders will look for signs that an economy is either strong or not. Before these reports are released, there is a certain amount of speculation as to what they may be, and traders will buy or sell currencies in anticipation of these results. For example, if the majority of traders think the results of an economic report will be negative, they tend to sell the currency ahead of the release, causing the price to fall. When this happens, we refer to the markets as being priced in, meaning that by the time the event has taken place, the price has already changed as expected. If the actual results are very different to what was expected, then this tends to have a big impact on the price of the currency. Price action can become very volatile, as traders price in the new and unexpected results. After a news release, the markets can still be volatile, even if the results are as they were expected, as traders need time to find out what the most probable impact of the reported figure will be. Therefore, as a beginner, it is generally best you stay out of any trades before and just after the release. Once you have more experience, you can learn about news trading and specialized strategies for it. So far,
So the question is, how do you track and keep up to the minute about all of these events? Well, they're all posted on what we call the economics calendar. The economics calendar is a calendar of all the economic events around the globe that are easily available, and keep track of the events, what assets will trade, what time the event is due out, or the information is due to release, what the last report showed this event was, what the market is expecting this current report, and then directly with data feeds, it gives you the actual data when it's released. So let me pop up one on your screen, and we'll quickly walk through it. So here we are looking at the economics calendar that's available on investing.com. Now they're available all over the place, okay? Because there's nothing unique about an economics calendar, because they all use the same data feeds from the same sources. So what you get is something that might be graphically different. So here we're looking at the economics calendar from investing.com. Here we're looking at the economics calendar from FX Street. They contain the same information, have the same data, but because the data feeds are coming out and there's so much data, including that data feed, the developers for the particular website can, it's simply just a matter of programming and telling a computer where to put certain data or what to do. So we look here on FX Street, and we can see here we have red lines. These indicate the volatility and the impact or the importance of that particular event. Okay. Now we'll talk about what that means. What we have instead of the red line is we have 3 bullheads, because all the economic data is based into tiers. Each one of these tiers has a number. So all that's happened is some developer for FX Street said, when you see tier number 3, give us a red dash. And investing.com, the computer programmer said, when you see tier number 3, give us 3 bullheads. Some use explanation marks. Some use stars. There's all kinds of things, but it's the same piece of information. So the first thing you're going to get is going to be the time, which is standard. You're going to get the currency that was involved. You're going to get the name of the event. Then you're going to see the previous, all the way to the right. The previous is the last time this report was released. And then the only time that you might get a different number is under what we call the forecast. Because most of these events are released by the government agencies or by big reporting agencies like Thomson Reuters. Most of none of the government agencies release forecasts. They don't tell you what the number most likely is going to be. They release the data. But the markets want to know what is expected. Now, so these forecast numbers here come from different sources. Like a lot of times you'll be reading in Bloomberg, our survey for the jobs report based on our 100 economic advisors we talked to says we're expecting this number. Okay. Or Bloomberg might say it, or MarketWatch might say it. Okay. There's all types of ways that this forecast comes. But the forecast between one website to another hardly varies at all. They are pretty reliable, but they're not locked in stone because they're just a market guesstimate. But it becomes a very important number for us traders. Okay. When the data is released, we get the actual. Now, as I mentioned before, we have what could be called, one of the most important things is this level here. It could be called impact, importance, tier, volatility. Each website tries to put their own little name on it. But all economic reports are based on 3 levels of importance. There's level 1, which is lots and lots of reports. Now remember, government agencies and statistical agencies didn't develop these reports for financial markets. These are reports that governments need, that businesses need. Now, there are some that are very important to the financial markets. There are some that are important to the global markets. There are some that are major pieces of information about an economy. These are called level 3 events. Okay. And they're all level 3 no matter whether you're on FX Street, investing.com, or Billy Bob's website. Okay. Now, these level 3 events are the only ones that really can move the markets. Level 2 events are kind of important and might have some long-term effect. But a lot of times, level 2 events are sub-reports of a larger report. And to give you that example, so right now, let me get my marker off here. Right now, I've filtered down, because the calendar is huge, I filtered down to only the countries that are important to us. Because unless you're trading the Argentinian peso, that actual data from Argentina is not going to affect you. Okay, you don't need to know Indonesia. So you need to pick up the countries that are releasing data that have importance to your trading or the markets that we're in. Okay, we also have the category of events, so we can. All this is doing is filtering your calendar. Okay. Now, basically, for us, we need all of these events, but then we have level 1, level 2, and level 3. Okay, if I were to leave all of this on for just the countries where I'm looking at, this is how long that economics calendar would be. More than I could deal with. Okay, so initially we get rid of level 1 events because they have no direct effect on the volatility of the markets, and they won't even really affect the stock markets, okay, or a particular stock. Now, it might be an odd and end health report on something to do with health, and if you're trading a very specific stock that's directly related to healthcare, it might have some inkling of an effect, but nothing that it will be a tradable effect. Level 2 are important, and we should be aware of them because they could affect something in the markets, but they won't create volatility. Level 3 are the most important events. Now, right now alone, if I just look at this week, you have all of those level 3 events. That's more than enough for me to look for trading opportunities and ones I would have to keep aware of. But we're going to use for tonight's class, for example, Friday's non-farms payroll report, which is one of the most important reports on a monthly basis, and it's basically the U.S. jobs report. So that is due out tomorrow. Well, this jobs report consists of a lot of important reports and sub-reports. So all of this makes up the U.S. jobs report. All this is released at the same time, and it's all out of one major report. And the U.S., we call it the non-farms payroll report. Okay. Now, all of these events repeat over and over and over again. So you're not going to master all the names. Like in the U.S., our big payroll report is called the non-farms payroll report. In the U.K., the big payroll report is called claimant count. Okay. In Australia, it's just called the jobs report. Okay. So it contains things like hourly earnings, monthly hourly earnings, yearly. For us, it's the non-farms payroll report. Okay. Or for the U.S. Now, why is it called that? Because the Labor Department was only tracked in the old days or responsible for jobs that were not involved in farming, because the farming department covered all the employment for the farms. So it was everybody included in all payrolls except for those involved in farming. Today it's changed a little bit and it covers just about all jobs. Participation rate. Then we have private non-farms payroll, and then we get the all-important unemployment rate. Now, you need to know this because it's going to have an effect on the U.S. stock market tomorrow. It's going to have an effect on the value of the U.S. dollar. It's going to have an effect on the gold tomorrow. And when this report comes out, it can affect all of these. And therefore, if you were trading the euro US dollar, you're trading the pound US dollar, and this report came out really negative, the dollar might fall. Might. And therefore, the euro, the pound dollar, the pound would have gone up. Now, the pound hadn't moved at all because pound didn't do anything. But because the dollar fell, the value of the pound went up. So you have to know what all of these reports are and why they're important. And you have to learn how to read the calendar. Now, the calendars make it pretty easy. Any line you have, okay, once you filter down and you want to see them. So if we want to go back to Friday's jobs report, we want to understand what is the non-farms payroll report. Just what? Click on the line. It's going to open up and tell you exactly what it is. It's going to give you all types of charts and information that you can use. FX Street. Again, click on it. It's going to give you all kinds of information, and it'll give you all types of charts that you can use. Here we have the actual to the deviation. We have the true range. You can pick exactly what asset you're looking at, and you can see how this will affect that particular asset, the volatility rate based on the particular asset, the impact, the deviation impact. Okay, it gives you all types of information. Now, some calendars give you a lot, some calendars give you a little. Okay. Back on the investing.com one, we have down below, we can see all of the reports, and we can see 1 year, 2 years, 3 years. We can do a bar chart or a line chart, and we can compare previous to current. We can see all the last reports. All the information is there. And the nice thing is these are all available with the forecasts about a week before the releases. So you can, like, at your leisure, start going back and analyzing them and figuring out what's going to happen. But before you do that, you have to understand what these events are, how they work, why they work, and which ones are significantly important and why they're important. So let me share another little presentation with you on economic indicators. And then we're going to talk about how to incorporate this into your trading.
Indicators measure how strong an economy is. It is important to understand how strong an economy is because the strength of an economy has an impact on the value of the currency. These indicators are released as reports, and the publishing times are released ahead of the actual publication. Interest rates are one of the most important drivers of the currency markets. They are normally set by a country's central bank. For the United States, interest rates are set by the Federal Reserve Bank, and for the Eurozone, the European Central Bank is responsible for setting the interest rates. The central banks use the interest rates to promote economic growth or to curb inflation. Let's take a look at the mechanisms behind this. The central bank of a country lends money to commercial banks, and the interest rates set by the central bank are what the commercial banks have to pay for borrowing the money. This is referred to as the base interest rate. These commercial banks also lend money to people that want to buy things, such as a house. The minimum interest they have to pay is the minimum based on the interest the central bank has set. So, if the central bank changes the interest rate a commercial bank charges also changes. Now let's have a closer look at how the interest rates specifically affect a country's currency. When the central bank increases the interest rates, the cost of borrowing goes up. This means that homeowners now have to pay more on their mortgages and, as an effect, have less money to spend on commercial goods. Therefore, the demand for these goods, like cars, will go down. Manufacturers are now faced with a lower demand for their goods and are not able to raise the price that much. Therefore, raising interest rates will curb the economy by decreasing the demand for goods and services and will reduce inflation. However, when the economy is not doing so well, the central bank might want to decrease the interest rates to stimulate the economy. Now, when the interest rates are lower, a homeowner spends less on his mortgage and therefore has more money to buy other goods and services like cars. These goods need to be produced, so by lowering interest rates, production will rise and thereby stimulate economic growth. Of course, it is not just mortgages that are affected by interest rates. Factories and other areas of industry borrow money to invest in growth. When interest rates are low, the cost of borrowing is low. Business owners will be more inclined to grow their business and will therefore borrow money. This money is invested in the economy, spurting further growth. On the other hand, when interest rates rise, business owners will not continue to invest as much because it is more expensive for them to do so. The economy will slow down as a result of less money invested. A higher interest rate means that you gain higher rates of return for the money you hold in your savings account. This is also why higher interest rates benefit those who have savings. If one country has a higher interest rate than another country, money will flow into the country with the higher interest rate because investors will get more interest on their money. Because the country with the low interest rate currency has to be exchanged for the country with the higher interest rate currency, this increases the demand for the higher interest rate currency, and the currency appreciates in value. Inflation measures the rate at which prices of goods and services rise in a given period. If inflation is too high, prices increase significantly and therefore reduce the purchasing power of money. In other words, the disposable income that consumers have is reduced. This can have a negative effect on the economy and hence the currency. However, if a country experiences low inflation, prices become stagnant or rise too slowly. Investors could see this as an indication that the economy is not as strong. Therefore, this could also have a negative effect on the value of a currency. To protect consumers from excessive inflation, central banks will tend to raise interest rates. This is because it reduces the spending power that consumers have, and so there is reduced demand for goods and services. Under reduced demand, the price for goods and services are kept to an optimal rate. When inflationary data is higher than expected, traders may buy the currency of a country in anticipation of an interest rate hike from the central bank. However, it depends on the economic conditions because excessive inflation could erode the value of any capital within that economy, which means that the value of the currency could decline. The terms hawkish and dovish refer to how a central bank will manage the balance between inflation and growth. If a central bank is concerned about inflation, it is considered hawkish and is more likely to adopt a higher interest rate. If a central bank is concerned about growth, it is considered dovish and is more likely to adopt a lower interest rate. So far, you have learned that economic reports.
So these economic reports that we get, it's important to understand how they're interrelated and what they're trying to tell you. But they on their own don't provide you really trading opportunities. They offer more investing opportunities, because if a piece of data is pretty good, it means US data, it means the dollar will get stronger. But it's not going to happen immediately. It's going to happen over the longer term. But for trading, it also offers us many opportunities. Like I said, if you're trading B&Q and the building data comes out very weak or inflation data comes out very strong, it could have an effect on the stock because it has a direct reflation to, or a retail sales report comes out and they're very bad, and you're dealing with a retailer like B&Q, it's going to have an effect on its stock. Whether it's a tradable effect or not, we're not sure about, because it's not a direct relationship. But if you were if you had bought the stock in the hopes it was going to rise and it had risen, maybe it's telling you maybe you should close out your position. Or if you were looking for that B&Q was going to fall over the long term or over the next 2 days because you're expecting some negative other data, and you got this, it might help you. It might be a clue to making your trading decisions. But when we're trading in CFDs and Forex, we're looking at very short-term trades that last an hour to a day, maybe 2 days. We can trade these economic events, especially in currencies and in gold and oil and some other commodities as well, because the stock market more responds to earnings reports. Okay. And earnings reports are also considered fundamental data, and they come out on an earnings report calendar. In fact, let me pop you over to investing.com again real quickly. And if we go over on the economics calendar, just go over to earnings, it'll give us all the earnings, all the companies that are scheduled to release earnings for today, tomorrow, the week, we see, and what we expect and what's going to happen. We can see dividend reports when they're due to come out and what they did, because dividends, especially a high declared dividend, will tend to rise a value of stock. Same thing, we can see splits when companies are announcing splits in their ratios, okay? And then we can see the expiration date of certain commodities. But earnings reports have a more direct effect directly on the stock. But tonight we're talking about the economics calendar, which is economics data. So let's go back, and I'm going to tell you a story. The story is called Your Kids and Their Report Cards. And if you think about it, an economic data release or the economics calendar is like a report card. All these economic events are reporting what the condition of the UK economy is, or the US economy, or the Eurozone economy. So they're like report cards. So you're sitting down to Sunday dinner with your kids, and you say to your son, well, kiddo, report cards are due Wednesday. How do you think you did? Well, your kid's fairly reliable. He's a good kid. He doesn't, lie to you. And when you ask him a question, you trust his answer. So he says, well, Mom and Dad, as you know, last semester I brought you home all C's. And they said, we know. He said, I think this semester it's going to be mostly C's and C pluses. A little bit better. Well, you as parents accept his word, accept his projection or what he's telling you, and you have to do your parental thing. You're going to, get on him a little bit, tell him, you know what, kiddo, you got to get better grades than that if you want to get to university. You've got to study harder, a little bit less Facebook time, a little bit less soccer, and more time cracking the books. You might offer to get him a tutor if he needs tutoring. But the fact is, you didn't call the school. You didn't check out their grading system. Maybe they got a little harder on the kids, maybe a little less hard. Maybe they're taking more standardized testing. You don't know. You just know a C is average and C plus is average because you didn't do any analysis. And an economic report also does no analysis. You're getting straight data. On the jobs report is how many people were hired. On the unemployment report is what is the percentage of unemployment. Not whether it's good or bad or indifferent for this time of year. It's the number. Okay. So what we have now is we have the previous, that was a straight C's, which was the last time his last report, and you have the forecast. Which you talked to him on Sunday dinner. He told you what he's expecting on Wednesday's report. Same thing as an economic calendar. You have the previous, and then about a week before it released the forecast. The forecasts are just estimates. But you as parents now have responded based on your conversation to what he's telling you he thinks he's going to get. or his forecast. Same thing happens in the market. The price of the assets adjusts to the forecast. Whether the forecast be good or bad, this is what the market is now expecting. So it sets your expectations. Now, come Wednesday, he comes in the front door, hands you the report card. You open it up, and he's got you all B's. You're thrilled. You're ecstatic. You run out the back door and say, hey, kiddo, I'm going to take you over to the mall. We can buy whatever you want in the sporting goods store, and we'll go to McDonald's for dinner. You can get, your favorite Big Mac. Okay. So you say, let me put dinner away, and we'll go out. Because you're thrilled to death. Why? Because he got all B's? Not really. It's because his actual was much better than his forecast. It was better than your expectations. Because on Sunday, if he told you he was going to get all B's, you would have said, well done, kiddo. But don't forget, you still got to strive a little bit harder. But because you were expecting C's and C pluses, and he brought you home better than you expected, you had a very positive reaction. And this is what happens in the market. Okay. So in other words, if we would expect 100,000 jobs created by the US every month, if this is what the average is, and last month we had 100,000 jobs. This month, though, there was a lot of snowstorms, there was some bad weather, there was, whatever else. And, this is when Trump shut down the government for the 2 weeks. So we expect less hiring. So we're expecting 50,000. Although we know the average is 100, and last month was 100. Now the report comes out, and we actually created 85,000 jobs. Well, on the average, that's still not a good report. On the whole, compared to last month, it's still not a good report. But because we were forecasting or expecting 50,000, we get a very positive response. In fact, we're going to get a jam. You'll see dollar soar up, the dollar fall back down, the dollar soar back, because then the volatility is going to hit it. You'll see gold take a leap. You'll see the stock market, the Dow Jones and all the other stock markets jump because they'll rally. After a couple hours, and all the analysts get to it, everything's going to go back to normal. Because they're going to realize, it was better than forecast, but it's still below average. Because even though we react in the financial markets immediately, investors, businesses, the central bank doesn't look at one data report that was released today. They look at least a quarter, okay? And they look at overall projection. Because, see, you can have that really bad data report where we got 85,000 jobs when we were expecting 50, which is better than expected. But next month, when Trump opened the government again, and everything went back to normal, employers hired like crazy. So next month they hire 125,000 people, and so the average ended up better than what was the 2-month average. So all of these things have to be taken into consideration. But for us who are CFD traders and short-term traders, we're looking for that initial reaction. We're looking at that reaction against expectation. So let me share with you a little presentation on some strategies you might employ to trade any fundamental analysis. And
particularly right before a news event, the market gets very slow. So I can expect the market to slow down or to tighten or to whipsaw or to channel. It can absolutely look at a smaller, tighter range occurring before the news as traders wait for this special number to come out. I then wait for the news event to come out and I do nothing. And so as you see it here, this large red candle right here was the result of whatever economic news event occurred. Whether it was good news or positive news, it doesn't matter. And so this red candle is the result of whatever the report stated. Now, typically, let me just go back here and show you as if we do not know the future. Typically, when a news event comes out and it's a red bar, a lot of traders say, well, this market's going to go down, I'm jumping in short. But really, there's no known fact that a negative news report will result into a downward market, or a guaranteed result that a positive news event is going to result into the market going up. And so I really can't base what I'm trading on that alone. And so since I concentrate on trading price and price action, I'm not using any indicators whatsoever. And that's the beauty about the way we trade here at Day Trade to Win. There are absolutely no indicators used except for the Atlas line, which is proprietary software when trading. So this particular method is only using price to dictate what we do moving forward. So now I relate to this candle as a chaotic candle based on a news event occurring, and I look at it as it being red or green. So is this candle red or is it green? Very simply, it's a red candle. And therefore, I'm not going short, I'm going long. I want to do the absolute opposite of this candle reaction to the news. But I'm going to be smart about it. I'm going to do it with specifics, with objective rules, and moving into the future, I want to have proof. I'm going to let price prove that to me, that we are going long. So as the market starts moving into the future, you can see that traders that were short the market based on that news event are now having a little bit of a problem. They have to cover their shorts or get out of the stop or even reverse because the market is not moving in their favor. Hence, what occurs next is that the market explodes to the upside. And the reason why you see this large green bar right here is a result of the traders who got in short initially based on the news event being wrong and having their stops hit or hitting that reverse button on your dome or on your trading platform, on your matrix, and initiating a huge move in the opposite direction. I'm entering long this market when 2 consecutive bars close on the opposite side of the highest high of this red bar. Now, if this was a reverse, if that candle was green, that in that initial move of the market, reaction to the news was green, I'd look to be doing the absolute opposite. I'm looking to go short when 2 consecutive bars close below the lowest low of that green bar. So in this case, this happened to be a bullish move to the upside, and it occurred because of that news event effect. So now as I go into the future, you can see that the market, let me just resize the chart here, you can see that the market exploded to the upside. I think this is a very direct way to trade the news. It takes all the guessing out. It's objective.
Now that's one way that you can attempt to trade news events. There's all types of ways. I use a matrix that I call market neutral, market negative, and market positive. And the nice thing about this is you can set this up way ahead of the event. So while you're sitting at home on Sunday afternoon and the wife's out with the kids, you know what? You can go to the economics calendar for the week in front of you and start setting up your matrix. And what I do first is I look at the major economic events on the calendar, and I look at that event, and I look at it, and the first thing I say is, what would be market neutral? Market neutral would be the area around that event that I don't think it would cause any market volatility or a tradable effect. So again, if we look at the non-farms payroll report, and we were expecting 100,000 jobs, and we go back and look at historically how much that job, because you have to have some idea of what where it should come out historically, what it was this month, the year before, what has been the last quarter, and say we calculate that the average over the year is 100,000, but this is always a good hiring month. So for the March report, we'd expect it a little bit higher because it'll average out after the February winter report. So we're expecting market neutral to be a range. Okay. So the report forecast is expecting 100,000 jobs. The average we know is 100,000, but we're expecting this month it could be a little bit higher. So what we're going to do is we're going to build this market neutral area. So we might say between 90,000 jobs and 120,000, that's going to be market neutral. It's not going to give us any type of tradable effect on the markets, especially short-term effects, because we're only looking for short-term effects for us. Then we're going to look at what we call market negative. Market negatives, where this report would be that would cause the asset or say the dollar to fall and gold to rise. Where would that report be considered significantly enough negative to create a tradable effect on the markets? Well, if we know that we set market neutral from 90,000 to 120, market negative would be anything below 90,000. Then we have market positive. What would be a really good report? Anything above 120. Okay. Well, that sounds really simple, doesn't it? Okay. Well, it isn't. Because once we built those ranges, we have to figure out what assets we're going to trade, what the effects will be on that assets. But this is giving you some general guidelines. But then we come to a whole bunch of other things we have to add into it. And let's pop up the economics calendar again. Okay, so tomorrow's report for the non-farms payroll report consists of all of these pieces of data. Well, you see that 2 are level 3, but we can't analyze 2 level 3 events simultaneously because they're part of one report. So we start out with the payroll report. So you can see we're expecting 175,000 jobs. So if we had gone back and done our analysis, and we know the markets, if you've been watching this report over a long time and been trading, we know the markets won't really move at all if it comes out at 200,000, and we can say 160 would be negative. So over 200,000 would be very market positive, under 160 would be negative. But guess what? We have to add in all these other parts of this report. So the next part we're going to look at is the unemployment report. We're expecting 3.8%, but we can't add these two together. They're two completely different types of numeric values. Okay. So what we have to do is we call these bumps. If this report, the unemployment report, comes out at 3.8 like is expected, it won't have any effect on the overall market neutral, market positive, market negative. But if this unemployment report comes out at 3.7, it would bump whatever that previous report a little bit up, a little bit farther up the scale. Because say that report had come in at 190. So it's the higher end of market neutral, but not enough to make a tradable effect. But we got a bump because the unemployment report was better. So that bumped us a little bit into market positive territory. So we have to look at all of these other events, figure out their significance, because not all of them are significant. A month over a month to year over year isn't much of a variable. So we'll look at the month over a month. Okay. The participation rate is quite important, but it doesn't have a forecast. But what we're looking at, because we have almost full employment in the U.S., we're looking at participation rate. That's how much of the U.S. are actually in the market or participating in the job market, working basically. And then we want to look at average hourly earnings. We want to see that earnings are going up. That means people who had accepted jobs that are less than what they were getting before are now seeing raises, or unemployment's down. We should see wages going up, because what happens is unemployment goes down. There's less people in the jobs market, so employers have to pay more money to get to hire new people. Okay, we don't want to see it rocket, but we have to see wages increasing. So we want to see hourly wages increasing. So those are a little. So we want to see those bumps up and down also. So there's a lot of things to figure. We also have what we call adjustments. Now, the previous report is what that data was at the prior release. But we get adjustments because all the statistical data that's analyzed from huge amounts of sources by the government agencies. And a lot of times throughout the month, they're updating all the data they've gotten, because it doesn't all always come in time. And they realize they have to do some adjustments because the prior month's report was inaccurate. So they can't lump it into this month. So what they do is when they release the current report, they also release the adjustment to the prior month. So let's go back and see if we had anything that happened like that today. Yes, we did. So as you see, today we got U.S. jobless claims. What you see is in the previous, whenever you see a red or green in the previous, means it had an adjustment. If you put your cursor over, so we can see that this was revised down from, from 211,000 unemployment claims to 212. Okay, it's a 1,000 person adjustment, but that's a negative adjustment because it means more people are unemployment. So what happens, we got a very good report this week on the actual, where we see it was in green. It was much better than expected, but we also have to calculate it. So it was much better than expected, but we calculated a bump down, okay, because we had a downward revision from last month. But it was a small downward revision with a very good report. So it still stays in market positive territory, just not as far in market positive territory. So there's all types of analysis you can do. But you have to look at the economics counter every day. You have to be aware of all these events. You have to be aware of how they affect and what they affect, because their overall effect will affect anything and everything you're trading. Because it's so easy to make a perfect trade. You know, you set everything up, but you didn't look at the economics counter and missed that Mario Draghi was making a speech at 2 o'clock today. And you've got the euro going up. And at the end of today, the euro had gone up 100 points. You had a beautiful trade. You were completely right about everything, but you got stopped out because when Mario Draghi was speaking, he had some negative tones or some dovish tones, so the euro fell. But it recovered as soon as the speech was over and did exactly what you thought it was going to be. But because you weren't watching and you didn't enter your trade 15 minutes or an hour before his speech because you didn't look at the economics counter, guess what? You ended up with a losing trade instead of a winning trade. So being aware of fundamental analysis, being aware of all economic events, being aware of the economics counter, and understanding how these all relate back to when a central bank does something, what can be expected. Like if you understand housing reports in the US, you know, housing reports have, because they're not just generic, they come out different days. We have new houses, we have resale houses, but we have building permits, we have sales, because a house is sold, but it's not finished and delivered until it's finished being constructed. So a new home sale consists of 3 steps. It's the actual sale, then it's when the builder pulls the building permit to start construction. That means it's gone under construction, and then the actual sale, new home sales, are calculated when the house is actually delivered. So when you have, say, a bad winter in the US, you might see building permits down, but housing starts could be down also, but housing sales could end up being up because what happened was it was a wet, cold winter. So a lot of people who were looking to buy houses just didn't go out shopping yet. Okay. Also, because the ground was frozen, the weather was terrible, builders weren't starting to build houses. So all of that pushed off the actual delivery. But the housing market was great. It just had a bump in it because, and these reports come out different days and different times. And unless you're aware of them, you can make terrible mistakes. So understanding the economics, understanding the economic events, how they're interrelated, what they tell you together is critically important. So if you want to learn more about it, if you go to www.ubcfx and go to their education center, there's invaluable information about the economics counter, economic events, and fundamental analysis. So thank you very much for joining us, and have a great night now. Bye.